Welcome to today's Better Way Thursday workshop. We're so glad you're here to join us. And we have, Rizek, I forgot to ask you how to pronounce your last name. I'm already in trouble.
Rizek Housari. It's a unique one.
Wonderful, wonderful. Rizek Housari, who is a CPA and a certified financial planner. We've done a Better Way Thursday before on really basic, like money 101, really basic budgeting and those types of topics. But we know as hopefully that our financial interests and needs and questions, like as our finances grow, our questions and our needs grow. And so we wanted to have like a money 201, a wealth management kind of discussion, especially as some of us are moving into maybe our first job where we were offered a 401k, where we were maybe even offered stock options or something like that. And so Rizek was kind enough to join us today to give an overview of wealth management over a lifetime. And Rizek, I only know a little bit about you, so I'm going to ask you to introduce yourself and take
Yes.
it away. Thank you so much.
Thank you, Robin. I'm excited to join you today. I told Robin before this meeting that one of the big reasons that I love working in the job that I do, which is financial advising, is because I get to help empower families. And I mentioned to her before that I work with a lot of different clients from all different backgrounds, but especially I love working with women who are professionals or who just really drive the decision making for finances in their household. And that really stems because my mother, when I think I was probably in fourth or fifth grade, she went back to school to get her bachelor's degree and to become quote unquote a professional, I guess, to help support the family. That really motivated me later on in my life when I went to college and eventually into my career to help women understand those crucial things around personal finance, 401ks, investing, life insurance, real estate, really all those things that maybe you wish someone would have taught you that you never learned, or you just maybe got bits and pieces along the way. So today I'm going to teach you as if you were my mother, right? And really just help you from the bottom. We'll build a foundation. And then, like Robin said, if you have questions along the way, let's get to them. I know Robin has a bunch of questions that you've already asked before this meeting, so we'll get to those too. But I'm going to hop into some slides that I've prepared. And I don't want to spend too much time on them, but I think it will be helpful to kind of guide the discussion. So I'm going to share my screen with you right now. Okay, perfect. So money can be stressful. I get it. It can be very overwhelming. Let's make it fun today. The first thing, here's some questions that you may have, right? How much should you save and where should you save it? What type of retirement accounts might make sense? Should you go with an IRA or maybe a 401k with your employer? We'll answer some of the questions that you should think about before you make that choice. Are you invested the right way? Or what does it even mean to invest? And are there any tax strategies that you can consider? Now, while I am a CPA, we won't get too nerdy today, but we will make it some real life, easy to understand examples that could really move the needle for you. And then because many of you are going into tech, you'll probably likely get some stock options or some kind of equity, depending on the company or the organization that you work with. And so we'll chat through some things to be on the lookout there and maybe different negotiation strategies for you. Okay. So we've jumped in. Let's get to the fundamentals here. Okay, it all starts out with an emergency fund. This is nothing new. Typically, we say 3 to 6 months as a rule of thumb. And that's something you want to keep liquid. That really just means cash, right? You don't want to invest your emergency fund because if something were to happen and your investments are down, that would really stink to kind of be forced to take it out. So this is kind of like cash at the bank. There's some really great options right now with interest rates rising. So it's not all doom and gloom, right? If you're out there looking for a mortgage or finance something, but with interest rates going up, savings accounts are now paying, somewhere in that 2 to 2.5% range. If you go to like an online high yield savings account, oftentimes credit unions or kind of the big banks don't offer them, but there are some great options for you to consider on the emergency fund side. Okay, let's keep
Rizek,
going.
can I ask a
Yes.
quick question?
Yeah.
Why is it so important to have an emergency fund?
Oh,
Like,
what a good question,
it's hard for
Robin.
a lot of us to put together that 3 to 6 months of
Yeah,
income, right? And
it is.
especially for just getting a new job, like we want to do other things. Why is that emergency fund so important? Why do we start
Oh,
there?
totally. I mean, you look at Meta, right? Facebook, they just laid off roughly 13% of their workforce recently. And you just never know with companies or organizations. And really, the whole point of you, I would think, maybe not the whole point, but a big reason that you became a part of Tech Moms is to become financially independent, to give yourself the skills, the education, the network that you need to empower you and your family for the future. Having the emergency fund allows you to have something to fall back on. And eventually you get that emergency fund large enough that you have excess money. And that's when things really get powerful for you because you can invest that and do other things. I'm all about financial independence, really positioning yourself to be confident in your future so that if something were to happen, you can be comfortable, you can sleep at night, or you can venture and do your own thing. I work with a lot of small business owners, especially in the tech and the telehealth side of things. And when they get to that point in their career where they want to venture out or join a partnership with other colleagues, if they have something they can fall back on during that period of time in transition, it really sets them up for success. So great question. Great question. Keep it coming. Say core savings principles. It's important to pay yourself first. You already know that. There are so many other organizations and people vying for your money that if you don't set it up automatically at the beginning of every paycheck, or you just have some strategy in place to pay yourself first, you will find that you'll spend everything you earn. Start today. Perfect. All right. This is something I know you've probably seen something like this before, but it sinks in every time I see it. It motivates me just a little bit more. This chart is showing that if you saved $1,000 a year, so 83 bucks a month, and you got a 10% growth rate, which is about average for the stock market, from the age of 21 to 31, you would have saved $10,000, $1,000 a year. And then if you didn't put another dollar in after that, it would have grown to a sizable amount there, almost $500,000. If you waited, which I'm sure a lot of you are older than 30 or 31, that's fine. There's still plenty of time. Point is, on this chart, if you save and start early for your future, it will pay in the end. It will pay in the end. So we'll talk more about that later.
And Rizek, yeah. I want to throw on this idea there because most of us, like most tech moms, are over 30. We have very few women.
Awesome. Just making sure.
Like even if we didn't do it ourselves, what a powerful thing for us to teach our children, right? That we can look at our kids and say, you know what, we saved a little money in our 20s. You can start saving, and show our kids a chart like this. So even if we didn't save that $10,000 in our 20s, we can set up our kids for a better financial situation than we even had ourselves. I love to teach this, to learn this as moms, because we have so much power and influence for the people that we love.
That is so true. I'll tell you, Robin, you bring up an excellent point. Those families that I work with who have a solid position right now, they have wealth that they built up over the course of their lifetimes, their children and their grandchildren, you can see the dividends pay off. I'm not talking the financial, but just their understanding of the world, opportunities, different things they can take advantage of, whether it's college experiences or just really an understanding of how the world works. It really opens the door. And so not only investing in yourself on the financial side, but you're right, it does pay dividends for your children later on because they'll see you saving. They'll ask questions about investing or retirement plans or health savings accounts down the road, and you'll be in a great position to share that with them. So there's some non-tangible benefits for sure. Let's chat just briefly about debt. Okay. There's all different types of debt. You've got student loan debt, mortgage debt, credit card debt. There's a wide variety. Those are the three biggest. Car loans is probably included as well. There's a few different strategies for you. Getting out of debt is critical. So you already know that. One is the debt snowball. Essentially, the debt snowball says, hey, knock out those little ones first. If you have a credit card balance with $1,000 on it, take care of that right away. Or if you have a car loan that's only got a few thousand on it, focus on that one. And then work your way up to the bigger ones, because those little wins will compound, and like a snowball rolling down the mountain will get bigger and really kind of give you that emotional support you need to accomplish. High interest first. That's more of like the scientific financial approach, I guess, just looking at whichever one costs you the most by interest rates. Of course, like credit card debt, that's going to be probably at the top of the list for you, whereas mortgage debt for most people is going to be near the bottom. And then with loan forgiveness, If that's something you're considering, whether that's through student loan, government forgiveness, or whatever, there's some tax implications you'll want to be aware of, as forgiven debt is considered income in the year that you're forgiven. So that shows up on a tax return, and that can shock a lot of people whenever they get that forgiveness. So two-edged sword there. Okay, let's continue on. Risk versus reward. You know this, right? A little more risk you take, the little more reward you can expect. I will say this, when it comes to insurance, I think it's often overlooked. There's two types of life insurance. You have term, which is cheap, and then you have permanent life insurance, which often is more expensive. And in that bucket, you're going to have really two types, whole life and universal life. I'm going to say something that maybe I'll disagree with some people on, but for the vast majority of people, term makes a lot more sense. It's cheap, it's inexpensive, you get what you pay for. The whole life stuff really does two things. One, generates a fat commission for the person that's selling you the policy. And two, it comes with a lot of fees, but it's sold because, hey, they have this little cash value bucket and you can kind of get some returns, but we can dive into that maybe later on if there's questions on it. But for most people, term is what you get, and it's cheap and inexpensive. I will say this, if you are relatively healthy and you have a normal life expectancy, it's not always advantageous to go through your employer for life insurance. Now, sometimes your employer will toss in like 50,000 of life insurance for you and you don't have to pay anything. That's great. Of course, you hold on to that. But if you're going to go shop out life insurance policies for you or for a spouse, it's really important maybe to go get a few different quotes. The reason is because if you go through a group term life insurance policy, you're grouped in with a lot of your coworkers. And if you know your coworkers are not healthy or don't have normal life expectancy, you're going to have to pay a little bit higher rate than if you're going to go out individually and shop for it. So something to think through there. Oh, and one more thing on the risk reward. Let's talk about income sources. For most people, their biggest wealth building source of income is their job, right? Their salary. The more places you can get income, the better off you can be, not only from a tax and strategy perspective, but you can just realize, hey, if something were to happen to me, maybe I have a rental property that's paying me, or I have some investments that are spinning out some interest or dividends for me, or some equity in my company that I'm building. So point is, it's important to have different sources of income. And really, as you get nearer to retirement, it makes a lot more sense that way. So perfect. Any questions, Robin, or should we keep going?
I loved what you said, and I know that we're going through this quickly, but I just want to emphasize the thing that you said about insurance. A lot of our women, when they get their first full-time job, this is really the first time they've had a job that has all these different kinds of benefits. And I've been through this a bunch of times. Like, you'll open up your benefits package, and there's disability insurance and life insurance and all these other things. And I love what you said, that anything that someone's giving you for free, take it, right? You got the 4 weeks of free disability insurance. You've got the $50,000 of free life insurance. Like, anything that they're paying everything for, totally take it. But in a lot of those other situations, you're not going to get the best deal just by doing it. So I just wanted to emphasize that, just because this is something that a lot of us are experiencing really for the first time. And so it's good to understand, oh, life insurance. Well, I know I need that. I guess I'll buy it here. But that's not probably, for most of us, the right way to go. That will be
It's
better
not always the best.
going online through the open market and finding a discount. And I love your advice as well about term insurance, especially for young people. Like, it's going to be such a good deal for us. Totally. I'm still young. I'm under 50.
Yeah,
right?
You are.
Awesome. No, this is great. Wonderful information so far.
Yeah, I would just stay away from the whole and universal life because the people that tout that stuff, they get paid a big commission by selling it, and it's typically not in your best interest. So for those of you who are familiar with Dave Ramsey, me and him see eye to eye on that, and no question. So unless you have a really unique situation and you're worth more than about $12 million, there might be a tax planning case for it, but call me when you get to that point. We'll take care of you. Okay, so when it comes to, you brought up a good point, Robin, disability. For the vast majority of working Americans, they are at higher risk of being disabled or not working in their job than they are of dying. And so disability insurance is not for everyone, but something for you to consider that you have in place. And like Robin mentioned, typically you'll get like a month or something, depending on your employer, for free baked into that. But you may want to consider having some disability insurance when you're first starting out. Once you've built up an emergency fund and once you have investments in different places, disability insurance might not make sense for you because you have those assets that you can lean back on in the event that you need to, but something to be aware of it for sure. Okay, investment 101. Diversification matters. It's that whole keeping your eggs in different baskets, right? You want to just have, you don't want to put everything in Facebook stock and for it to tank, more than 60% like it did this year. You really just want to have a little bit in a lot of different places. Really, when it comes to investing, you want to invest with a specific goal in mind or a direction that you're heading, right? If your only focus is to save for your retirement, a 401k might be a really good place for you. But if you have a shorter term goal to buy a rental property in 5 years, or maybe just buy yourself your own home if you want to stop renting, and you have that shorter term goal, a 401k probably is not the best choice for you. A brokerage account might be a much better fit because with 401ks and IRAs, these types of retirement accounts, they have some restrictions on them, like age at which you can withdraw. For example, with an IRA, you'll get penalized if you take money out before you're 59 and a half. So that would not be a good choice. The same with 401ks, it's 55. So something for you to think through. Okay, let's continue on. There's all different types of investments.
Wait, I want you to go back to that last slide.
Yes.
Because there are just some terms there that I want to make sure that we understand. You've already talked about the risk and reward. What do you mean accounts are not investments?
Oh, Robin, I'm glad you teed me up for that one. I did skip over that. Everyone thinks that when they say, hey, I'm investing in my 401k, that the 401k is an investment. Newsflash, it's not an investment. It's an account that gets special tax treatment. And when you put money in the account, you then have to do a second step and pick and choose which investment you want it to sit in. So when you get hired by an employer, if they offer a 401k or other retirement account, there's all different types. Simple IRAs, like 457s if you work for a government organization. There's all different types, but typically you put money in, typically from your paycheck, and then you have to make a second decision, which investment am I going to pick from? And these retirement plans usually have about 15 or 20 different mutual funds that you can pick from. Okay, mutual fund, that's a new word. A mutual fund is a basket of a bunch of different investments, and you buy a slice of that basket. So instead of you going out and buying this stock and this investment and this bond and this stock, you just can buy one that has a lot of different things in that mutual fund. So that's how it works. Now, I just looked at it. I had a family member send me one, and she's in her mid 40s and same kind of thing. She's going back to work. She sent me her 401k just the other day, and I looked at it, and with mutual funds, they're not all created equal. There are some that are very expensive. The way that you can tell how much you're paying for a mutual fund is by looking at the expense ratio. If you're taking notes, I'd write that down. Expense ratio. That tells you the amount of fees that you're paying for that investment. And for me personally, this is not formal financial advice, of course, educational. We got all the disclosures in. But if it were me and I were starting out, I would look at index funds as a large chunk of where I would put my money if I was just starting out. So what is an index fund? It's essentially that same mutual fund at a really, really low cost. And you're just buying a lot of different companies, a little slice of everything. You may have heard the S&P 500 on the news or on the radio. The S&P 500 is the 500 biggest companies you can buy in the United States. And if you were to go and buy an S&P 500 index, most 401ks have something like that in their fund. You get exposure to the 500 biggest companies: Home Depot, Facebook, Microsoft, Visa, MasterCard, those kind of companies. And that might be a good option for you to consider. The same with bonds. And let's pause for just a minute and explain. I know we're covering a lot of terms. Stock is you owning a slice of a company. If the company does well, the value goes up. If the company generates a lot of income, they might share some with you called a dividend. It could also go down. They're typically thought of as a little riskier, although I don't really think they're that risky, but maybe that's just because I've been doing it for so long. Then you have bonds. Bonds is you loaning money. So with stocks, you own the company, Bonds, you loan to the company, and then they promise to pay you back with some interest in the future. And so bonds are typically thought of as more conservative, although this year they're both down about the same amount. So that's a different question with the Federal Reserve and interest rates. We can dive in maybe another day on that. But essentially, go ahead.
I was going to say, I wanted to ask you a question about another type of investment, another type of
Yes.
fund, and
Yeah.
maybe you're already going to cover this, but I would love you to talk about target date retirement funds.
I love it. I love it. Let's talk about it right now. So the way a target date retirement fund works is, well, let's pause on that. I'm going to give you a little background for you. When you're young, typical advice is, hey, you have a long time until you need that money until retirement. So stocks is where you're going to get a lot of that growth in your portfolio. So for young people, it might be like 100% stock and no bonds. Then as you get older, maybe, in your late 40s, early 50s, you may want to start tailoring back some of that risk. And you might say, hey, let's go 80% stock, 20% bonds. And then in your 60s, maybe it's 60% stock, 40% bonds. Essentially, you're taking a little bit of the risk off the table because you're near to retirement. You want to be less risky. Makes sense. With a target date fund, that happens for you automatically. The mutual fund will have like a date assigned to it. So maybe the 2050 target date fund. And that is saying, hey, by the time we get to the year 2050, this person, we want them to be very conservative. We're going to plan on them starting to take money and income off of their nest egg that they've prepared. So right now, they're going to be fairly aggressive in the 2050 fund because we still got, roughly 30 years until they need the money. But once we get into the 2040s, they're going to start tailoring the risk back. Now, target date retirement funds, I love them if they're low cost. The problem is I've seen more and more of these target date funds creep in, and fee, like the one I looked at the other day, had a 1% expense ratio. That's saying, hey, to own this one investment, you're paying 1% to the manager of the investment to own it. That's really expensive, and I probably wouldn't recommend something like that. But if you can find a target date index fund, typically the fees are going to be closer to like maybe 0.2% or 0.1%, significantly less than 1 full percentage point. So big fan of them. They're hands off.
That's the expense ratio we want, like a very low, as low as we can see.
As low as you can see, typically, yeah.
So if we're going in, we're getting our very first 401k, and I hope you're going to be talking about employer matching and things like that in a minute.
We are.
Yeah. But we don't have to know tons about investing. We don't have to do all this stuff. That if we see an index fund or a target date fund with a very low expense ratio, that's a way that we can say, I'm doing this broad diversification. Yeah. I'm getting a lot of exposure, and then I don't have to feel like I'm an investing expert to still be able to get the benefits of being an investor.
Totally.
Okay. Totally. We had a question here in the chat. What would be a good mutual fund expense ratio?
Oh, good question. If it were me, I would say something below 0.2%. Yeah, that would be great. Oftentimes it depends on the 401k, honestly, and you could go, if you see expensive ones, go tell your employer, hey, go shop it out because you're not offering the best thing for you and your employees. But, typically you can see it like even 0.05%, 0.08. That would be great. Fidelity, Vanguard, Charles Schwab, they often offer low cost index funds within 401k plans. And so you'll look for the word index and then the expense ratio. And if it's low, it's very likely it's an index fund. And that can be a great source for you. I use it for myself, for my family. I use it for the clients that I serve. It's a great way to kind of, right when you're first starting out, hands off, easy approach. And like Robin said, you don't need to be some nerdy investment guru like myself to win with index funds. So I'm glad you pointed that out. Okay.
Can you do those last two terms for us? Asset allocation and opportunity cost.
Yeah, absolutely.
You're like, Robin, I want to cruise, but I love to know what these things are.
This is good. I don't want to bore anyone. So I'm excited. I love this stuff. I could talk about it till the cows come home, but asset allocation is essentially saying, hey, do you want to have it all in stocks, or maybe you want to have a little bit in bonds or companies outside the United States, or small companies, or technology, or real estate, or your own small business? Point is, sometimes people get too focused on just one type of asset class and they ignore others. It's often the case with financial advisors. They just talk about stocks and bonds. But me personally, like I own real estate. That's a great source of investment income. I'm all about it. Or owning small companies like private equity. Let's pause on the private equity. Maybe we'll come back to it another day, but you will probably definitely be involved with different rounds of funding if you start with a small startup or tech company. Essentially, a private equity firm will come and kind of bring cash in and boost the company to hire new employees or to expand operations. With asset allocation, it's just important that you recognize what your risk is. If you are really, really nervous about investing and all this is brand new to you, which it probably is. I know it was new to my mom. Maybe you start out in something a little more conservative, and then the more comfortable you get and the more you learn these terms, then you can ramp up the risk or more exposure to different things. But I'll tell you, with index funds, it's kind of a no-brainer. I think that's what I'd recommend if you were my sister. We'll say that. Okay, and then opportunity cost. This is a big one right now. So inflation, you know what it is. Right now, it's about 7 or 8% over the last year. By holding cash in the bank, you are losing 7% right now. If we look back over the last year, that's guaranteed loss. I don't know about you, but I hate guaranteed loss. I would never want to do that. But again, you got to have your ducks in the row. Like emergency fund, that's fine. I'm willing to take that kind of inflation guaranteed loss because I have something to fall back on. The point is, with opportunity costs, just be aware of what you're foregoing whenever you make a decision with your money. Oftentimes, I work with families where somebody will receive an inheritance from a parent who passed away, and they'll have this chunk of money. And whenever that happens, do not rush into your decision to invest that money or put it with your brother-in-law or do whatever. Take your time, think through your options, and just be sure that you're aware of what's out there, because there's a lot of people that want to take your money, and ultimately nobody cares more about your money than you do. And take time to grieve, take time to, be with your family, and then make that decision for yourself. So was there anything you wanted to touch on there, Robin?
No, that was awesome. Thank you.
We've talked about these already. These are some common investments. Stocks, again, that's ownership in a company. Bonds is loaning money to a company or a government. Mutual funds is like a basket of different investments. Real estate, we talked about that a little bit. Private businesses, alternatives.
Rizek,
There's a lot in this group. Yeah, you were going to say something.
I just wanted to ask you a question about real estate. And
Yeah.
I know like many of us are not in the position to have real estate investments, right?
Okay.
So like, can you talk a little bit about REITs or other
Yes.
options to get involved in real estate that don't mean I'm going to buy myself another house and rent it out to somebody?
Totally. So Robin brought up REITs. That's the slang term for REIT. That stands for Real Estate Investment Trust. They're not all created equal. Fair warning, I have a client. She's an older lady, and she was sold a REIT that she can't sell until her death. That's the worst kind of REIT. Oftentimes they're really illiquid, so you can't trade them and buy and sell them. I'm always hesitant of purchasing something that I can't easily turn around and sell. So with REITs, fair warning on that. But there are some great REITs out there that give you the opportunity to invest in real estate. It's kind of like a mutual fund. You're putting money in with a lot of other investors, and then they go and buy properties. Typically, they're commercial properties. So think warehouses, office space, those kind of things. And then as they receive rental income, they share a portion of that with you. So there might be an opportunity for you to think through, hey, I want to have a little bit of real estate in my portfolio without having to go and buy a $500,000 duplex or something. This can give you that option, but just be really, really careful and make sure you understand, can I easily sell this and buy this? And what do the tax implications look like? Sometimes that catches people off guard. So I'm glad you pointed out. With alternatives, that's going to be like crypto and other things. Again, very, very risky. I would not recommend it if you're just starting out. And so just be wary of that. I wouldn't take your salary negotiations and say, hey, I'll take 2 Bitcoin for $80,000, right? I would just be really cautious.
That's really one of the questions that we got from
Was
women.
it?
Like, what do you think of Bitcoin? What do you think about this? So, I mean, and I don't think we've really got time to get into it in depth, and
Sure.
it is complex. So one of the things that I'd love for you to answer for this group is I'm guessing some of these investments are very simple and some of them are very complex, and you've already touched
That's
on that
right.
a bit. For the brand new novice investor, first job, got a little extra income that I want to invest.
Yeah.
What are the investments that are the simplest that I can actually just do on my own or through an employer's fund? And what do I want to make sure that I'm enlisting the help and advice of a professional if I want to get into that?
Totally. I think for most people just starting out, you probably don't need an advisor. Um, an index fund could be a great choice. You could buy a total stock index fund that just gets you exposure to thousands of companies in the United States. Or if you want a global one all over the world, you could get a total bond fund that's going to give you, maybe 30 or 40% United States debt, which is really not very risky in the grand scheme of things because you're loaning money to the US government and they can always raise taxes to pay you back. So it's kind of a no-brainer that on that side, super low risk. Or you can buy a bond fund that's going to be like company debt. So you're loaning money to Apple, you're loaning money to Tesla, those kind of companies. So I would say like total index funds can be a really good choice when you're first starting out. I have some core beliefs that one, you can't time the market. So nobody knows when the bottom or the top's going to be. Two, nobody knows what the next Tesla is going to be or the next Amazon. And so just by buying a lot of different companies, you can ride the wave as companies grow. And sure, there'll be some losers. They'll naturally fall out and new people will come in. And by holding on to an index, you get exposure to that. Another thing I have as a core principle is that trying to predict the future is just a waste of time. And so anyone that's trying to tell you they've got a crystal ball or they know when to buy or when to sell, they probably don't. And it's probably just in your best interest. I think so maybe this was the next question. When is it the right time to bring in a professional or a financial advisor or a CPA or whatever into your life? Probably when you get to the point where you have tax questions or estate planning questions or questions around, am I taking the right amount of risk in the right places? If you're hiring an advisor to try and, outperform the market, more often than not, you're going to be paying more than what you're getting in return. And so I would just be sure you're getting advice and not someone selling you investments or products. Yeah.
Love it. Love it.
One thing on that, I would look for a fiduciary. That's a key word. Fiduciary is someone that's legally responsible to act in your best interest. You would think most people who call themselves financial advisors would be fiduciaries. The fact is they're not. And so if you're going to work with an advisor to help you in this, one of the first questions would be, hey, are you acting in my best interest at all times? Are you a fiduciary? Are you, what's your background? What's your experience? To kind of get a sense for who they are. And you can always check somebody on Broker Check. Broker Check is a website that the Securities and Exchange Commission has established with FINRA, where you can go and see the background of, an advisor, of a professional, to see, hey, is this someone that has any bad marks against them? Are there any complaints? That can help you give you some assurance before you go that way. But
Do
great
we just
question.
have to ask someone if they're a fiduciary, or is it like printed on their credentials, or like how do we know if we're like I've heard people
Yeah.
talk about a fee only financial planner or different
Yep.
things like that. Is that part of the fiduciary, or how does it all work?
Great question. So certified financial planner, a CFP, that's what I am. Anyone who's a CFP is a fiduciary. And so they typically charge fees in one of two ways. Typically, it's going to be fee only, which is where they just charge you a fee. Maybe it's like an hourly fee, or what's common is like an assets under management fee. So it's like a percentage of all the assets that they manage for you. They're not incentivized to like sell you some product like a expensive mutual fund or an annuity. Be careful of those, or some life insurance product, because whenever they sell those kind of products, they get a commission. And so that is something different than someone who's a fiduciary typically would charge. Like a fee-based would be kind of a blend of the two. But in my experience, like a fee only or a fee-based is going to be someone that's in your best interest. That's going to say, hey, regardless of what I recommend to you, my incentives and your incentives are aligned in some way. And so that's something to be cautious of. Yep, good questions. Good question. Okay, another graph for you just to sink in a little bit more to help you save and invest sooner. If you invest $10,000 a year right now At 8% growth for 30 years, you'll have over $1 million saved at the end of 30 years. That's 10,000 a year. So point is, start soon, and 8% is very reasonable rate of return on a wide variety of investments. Okay, let's jump in. Now for the good stuff, equity compensation. So when you are going to negotiate an offer with a potential employer, they really have kind of two levers that they can pull on for most tech companies. One is just straight salary, right? How much are you going to get paid? And maybe like bonus on top of that as well. That's pretty across the board for most employers. The equity piece really is exciting for people in tech because there's so many different types, and oftentimes people that want to get in tech are excited for the growth potential or helping the company, change a process or, help things work smoother or really benefit people's lives. And they want to have some skin in the game. And you can do that with equity compensation. So again, equity and stock, it means the same thing. It's you having ownership in the company. One common one is an employee stock purchase plan. This is where it's typically with publicly traded companies, so companies that anyone can go and buy their stock, but they'll offer this to their employees, oftentimes at a discount. So they may say something like this: hey, you're going to have this 6-month period of time. It could be any months, but I'm just making an example. 6-month period of time where we will look at the beginning price of our stock and the ending price of our stock. Whatever it is, we'll take the lower value, and then we might knock 5 or 10% off for you as an employee, and you can come and purchase as much as you want, up to $25,000. That could be really awesome, because if here's the stock at 10 and the stock has gone to 15, and now it's $15, you can buy it for 10 and sometimes even cheaper, and you can immediately turn around and sell it the very next day. That's like a no-brainer for most people to take advantage of an employee stock purchase plan. There's a few things to be cautious of with that. One is, is it public? Can it easily be sold? What's the discount going to be? And then there's some tax considerations you may want to think through, because if you hold the stock for a certain period of time, typically 1 to 2 years, then you might get some tax benefits. But for a lot of people that are making under 100,000, it may not be worth it to factor that into your decision. It might just be, hey, buy it, sell it the next day, and it's like you got a free bonus from your employer, and you pay a little bit of taxes on it, but hey, that's guaranteed money, as opposed to risking it by keeping money with your employer. And before I continue on, let me point this out. A lot of people I work with have equity compensation, and sometimes they'll put their own money in it. Sometimes they're just given it. Regardless, when you're thinking through equity for yourself, you want to think through this. Not only am I basing my income and the source of money that I'm receiving from my employer is going to pay for bills and for my kids' sports and for health insurance, but now I'm tying up additional money, my own investments in my employer. And if something were to happen to my employer, the economy went down, they had some layoffs, and I got hurt, the stock price is probably going to be down too. And now I'm tying my income and my assets in the same place. That is the epitome of being undiversified, right? Diversification is saying have it in a lot of different places. And so just be really cautious. Make sure you have a plan in place for when you receive that equity comp, that you don't let it get so huge that you liquidate or sell it and invest it in other places. So employee stock purchase plan we talked about. Stock options, there's two big types. There's non-qualified and then incentive stock options, or qualified. With non-qualified, both options, the way it works is the company gives you kind of like a piece of paper that says, hey, in the future, you can buy our stock at this price. If the stock does really well, you can sell it and then you'll have that gain. And with all equity compensation, what the employer is trying to do is put some golden handcuffs on you so that you perform better. You got some skin in the game. You'll work harder and longer and later. And that may not be something you want. Also, it's risky. You don't know for sure that company stock is going to go up. For some reason, everyone in tech thinks their company stock goes up until it doesn't. And oftentimes there's some busts. But just be cautious through that. And that would be a great negotiating tactic with a potential employer. They may come to you and say, hey, we'll give you $70,000 as a salary and $20,000 of stock. And you may say, you know what? I'd rather have 80,000 of salary and no stock at all. And you kind of meet in the middle or something like that. But it's super fluid when negotiating equity compensation. All right, Robin, what's your question or
Well, I was
statement?
going to say, and the options, like if they give you stock options, other than the opportunity cost of what you might be able to negotiate for it otherwise, that doesn't cost you anything unless you exercise the options, right?
Correct.
Right. Okay.
Correct.
So it's just a piece of paper until
Yeah,
you actually say, I'm going to buy at this price, and then you've made the investment.
that's
And
right.
you only would make it if it had grown and it was more valuable and things like that. But you're saying there is an opportunity cost to that because
Mhm.
maybe you can say, I don't want to take the risk on the stock options. I'd rather negotiate for higher salary.
Yep, that's a choice. You can make that, and many hiring managers will make that negotiation with you. Now, a lot of people getting in tech, they want that growth potential, so they like the equity piece. And you brought up a good point. So there's this word called exercise, right? Many people are going to be talking about it here in 6 weeks with their New Year's resolutions. But let's talk about exercise as it pertains to options. Exercise is when you say, "Hey, I want to take it to the next step." We'll say that's what that means. And with an option, taking it to the next step would mean you're going to put in money and actually buy the stock. And when that occurs, now you've got some additional skin in the game because you brought your own money in to exercise those options and make them yours. Because typically options have like a 10-year life on them. So with this, there's many ways to exercise. Sometimes your company may say, hey, you have to bring cash in. Sometimes they'll do a cashless exercise where the company will say, hey, we'll just trade your options for some stock and then we'll keep some for taxes. And let me pause on this. Tax planning is really important on the equity piece because sometimes if you got options at $1 and that tech company has shot the moon and now it's 50, which not unheard of. It's happened before, but it's rare. Let's face it. But if it has, and then you sell, all of a sudden you've got a big fat income hit on your taxes. And if you haven't been withholding enough for your taxes, you could get hit with penalties at the end of the year when you file your tax return. So just really important whenever you're exercising stock options or selling restricted stock units or restricted stock awards or phantom stock or any of these other types of options you might come across, whenever you sell or exercise, just be cognizant that you've saved enough away for those taxes. And when I say saved enough, typically we do that with a withholding. You just tell your employer, hey, crank it up, like withhold more from my payroll, or you can send money to the IRS. And you want to do that quarterly. So there's no penalties for you. So, yes. Wow. We went deep. That might have been tax 303. I'm not sure, but let's come back to maybe financial planning 201 for us here at Tech Moms. Are there any questions before we move on?
Don't go to the next page. I don't know what an RSU is.
Okay.
Just like real basic level, like just like one sentence. What are each of these things?
They're all forms of equity compensation that get taxed differently depending on their name. I wish I had an easier answer, but it's really with restricted stock units and restricted stock awards, it's like stock, but it's not. So you typically don't have voting rights is the big difference. So
Okay, cool.
as the company grows and gets bigger, the unit or the award will also grow typically at the same rate, but you just don't have any decision-making voting authority like you would if you were going to go buy an actual share.
Okay, cool. Good enough.
Yeah,
Thank you so
good
much. Super
questions.
interesting. I love to learn new financial terms. So
Yeah, and they come up with them all the time. The one reason is usually to get around taxes, so we can all thank Wall Street for that. They change the tax law and they come up with new awards. Okay, there's 3 buckets for your savings that you want to think through. And I just made a TikTok about this morning. I love TikTok. I just found it like a few months ago and I'm posting a lot of content. So a shameless plug, if you want to follow me on TikTok, or I'm actually on Instagram too, Finance on the Fly. And there's underscores between each of the words, Finance on the Fly. It's mostly because I love fly fishing. So there it is. Okay, but one I talked about this morning was a brokerage account. So a brokerage account is an investment account that anybody can open. You don't have to work to have this type of an account. Think of it like a checking account. You can put as much as you want in, you can take as much as you want out. You don't have to be a certain age. There's a lot of flexibility with this type of an account. And for those of you who are familiar with the app Robinhood, and again, I'm not sponsored or recommending anything by them, What I am saying though is that all Robinhood accounts are brokerage accounts. So it's just a place for you to store your money. You don't get those same kind of retirement tax benefits that you would with a 401k or IRA, but a good option and something for you to consider. It's where a lot of new investors will start. Then we have, we'll just go in reverse order. So let's go to tax deferred now. With tax deferred, this is your traditional 401k or pension plan or IRA. It's where you put money away today. And when you put that money away, so it's like you earn, let's say $6,000 and you put it in an IRA. It's as if the IRS does not look at that $6,000 today and they don't tax it. So you get a deduction or a write-off. If you watch Seinfeld and Kramer's like, just write it off. That's what this is, okay? You reduce your income, you put it in this account, and it grows tax deferred into the future. The kicker is when you take the money out in retirement, you're taxed on it then. The IRS says, hey, I want a piece of the action. So when you do a tax deferred 401k or IRA, and this is the plain vanilla 401k. So the default for most people in the 401k, it's going to be a tax deferred. The kicker is you become a partner with the IRS when you put the money in, because you and the IRS are going to both want a slice of the action when you take the money out. And the IRS is a partner that doesn't give up easily. And in fact, they never give up on this. So just be cautious. The reason most people go this route is they say, hey, I'm in my highest earning years right now. I have a lot of income. I'm paying a lot of taxes. I think that in retirement, I'll be in a lower tax bracket. And so I want to take the money out then and pay lower taxes in the future. That's all it is with the traditional IRA. You're saying, don't tax me now, tax me later. Another thing to be on the watch out for is you don't know what tax rates will be like down the road. There's nothing in Congress holding them back from changing tax law and increasing it when you're retired. There's nothing doing that at all. In fact, they did that with Social Security. Social Security used to not be taxable. In the 80s, they said, let's tax a portion of Social Security. And I don't think it's unlikely that in the future they could say, let's look at some of these total assets and tax them based on their total assets, as opposed to just how much they're getting in Social Security benefits. Okay, you got me on a rant, but just be cautious. We know for sure at the end of 2025, the Tax Cuts and Jobs Act that the Trump administration put into effect will sunset. In 2026, everyone's tax rates are going up for sure. It's guaranteed. It's written in the law if they don't do anything. But what I'm saying is it's likely that they will do something in the future to change and evolve taxes. And if you look back over the last 5-6 decades, we're in a historically low tax rate environment right now. Okay, so let's transition to Roth now. Roth is just some senator's last name, so it's not an abbreviation for anything, thank goodness. But essentially with Roth, what it means is you pay the taxes today, and then you can relax. You've paid your partner, the IRS, off, and you never have to worry about what tax rates will be like in the future, because Roth money is tax-free growth into the future forever. So if you invest money today and it grows and compounds over the course of your career, and then you take it out at retirement, it's not taxed at the state or federal level. It can be really beneficial, especially for single women who, they might want to retire in their early 60s before 65 when they get Medicare. And in between 60 and 65, let's say, they're on the hook for their own health insurance because they're no longer working and employers not subsidizing that health care. Well, if they're living on Roth money during that period of time, they'll get more benefits under the Obamacare legislation because it's not recognized as income. That can be a good strategy to consider for people who are, again, that's a really specific example. I recognize that, but with Roth, super powerful. Typical advice is if you're younger, Roth makes a lot of sense. If you're older, traditional or pre-tax makes a lot of sense. But again, each situation is different, so just kind of be cognizant of that. One more thing on the traditional IRA and the traditional 401k. When you turn 72, the government will force money out of the account. You don't have a choice. They're going to force it out and they're going to tax it at 72 and continue that until you pass away. A lot of people don't recognize that. And there are a number of families I work with that because they were such good savers in their 401k, now they're in their 70s, the government's forcing money out and they're paying more taxes than they ever did when they were working because their account's grown. So just kind of be aware These are the 3 different buckets that you might want to consider. And then one thing on the HSA, a health savings account. This is if you have a high deductible health insurance plan, then you qualify to open an HSA. A lot of small tech companies don't offer a health savings account to their employees. Fine, you can open one up on your own. It's not like a 401k where it has to be with an employer. Anyone can go and open a health savings account. And in a health savings account, it's one of my favorite accounts. All right, it's not for everyone, but it's one of my favorite accounts for 3 reasons. And they're all happen to be tax reasons. Maybe that's a CPA coming out of me. One is contributions to a health savings account are tax deductible. Remember, Kramer walking in the room, just write it off. So you don't have to pay taxes on it. It's tax deferred growth. So if you invest inside the HSA, well, let's pause. Most people don't recognize they can invest inside of an HSA, but it's a super powerful wealth building tool. The third is when you take the money out, if you use it for qualifying medical expenses, it's not taxable either. It's the triple whammy. No taxes coming in, no taxes on the growth, no taxes coming out for qualifying medical expenses. Again, it's an excellent account, but not for everyone. And you have to have a high deductible health insurance plan to qualify. All right, Robin, what's going on?
Did you see that question in here about what are limits to IRA contributions?
Yes, I didn't see that. I'm glad you asked. For 2022, it depends on your age. If you're over 50, you get a little extra $1,000 catch up, but for most people, it's $6,000. For 2023, they just raised it to $6,500. So that's what it is for a person. Now, if you're married and your spouse doesn't work, maybe they're staying at home raising the kids or whatever, and you're just the sole source of income, you can get an IRA and your spouse can do an IRA, called a spousal IRA. One thing to be aware of, there's income limits with IRAs. So if you make above a certain income, you can't make a contribution to a deductible IRA. The same with a Roth IRA. Now there's ways around it, like the backdoor Roth or the mega backdoor Roth. That's definitely getting a little bit more nerdy. That's when you might want to hire a professional to help guide you through those things. But I don't want you to limit yourself. Well, let's talk about the matches. Okay, so here we are on the 401k. We talked about the tax treatment. We talked about the investment choices. Be on the lookout. Not all 401ks are created equal. And oftentimes, when people leave an employer, they roll over their 401k. You've got 3 choices when you leave an employer and you have money at the 401k with your old employer. One is you can leave it there, but you can't make new contributions, just sits. The second is you can roll it over to an IRA, and an IRA is an individual retirement account. You're in complete control. I'll say that's the most popular option, but again, it's not always the best choice. And then you have a third option. You can take the money out and go on a cruise. If you do that third one, you have to pay taxes and penalties, and I don't recommend it. But that isn't the one thing. Some 401ks will let you take a loan against the 401k. Again, just be really cautious before doing that and make sure you look at the fees and the interest rates. Employer match. Okay. So with an employer match, that's where the company says, hey, we'll give you some money if you put some money in. So maybe you put in 3%, they'll put in 6. Or excuse me, let's rewind that. They typically don't do it like that. You put in 6, they'll put in 3. They might say, hey, we'll match you 50% up to a certain level. That way, they kind of encourage you to put some money away for retirement and save for yourself. There is something to be aware of. When they put the match in, it's not always yours right away. Oftentimes they have a vesting schedule, and you'll see the word vesting with options and equity as well. Vesting essentially is that golden handcuff saying, hey, you have to stay with us for a certain period of time before this money releases and it's all yours. You get the full right. So when you become vested, that means it's all yours. And if you leave, you can take it with you. And so just be on the lookout for a vesting schedule. One vesting schedule, as an example, might be a 4-year vesting schedule where they'll say, hey, at the end of every year, you'll get 25% of whatever we put in. And then after you've hit that 4-year mark, from here on out, everything we put in is going to be yours. And so that's something to be on the lookout, both with equity compensation and with retirement plans. Beneficiaries. With these retirement plans, it's important that you have a beneficiary designation. This is saying, if you die, where's the money going to go? If you name your children who are under the age of 18 as beneficiaries, it can create a headache if you go through the probate process. And so a trust might be beneficial in this place. For those of you who are probably you may have not heard of a trust, or you may have thought like trust fund, like that's something like I would never think of doing. It can be very simple to set up a trust. You could use an attorney and hire them for $2,000 or something, or you can do it online for 100 or $200. But it depends on the complexity of your situation. We won't dive into that today, but it's important that you have somebody named, a spouse, or maybe you have your children named. But if your children are named, you want to have a will and other things to make sure like there's a guardian that's going to take care of that money. Because if you name your children, I'll give you an example. If you name your children beneficiary of this 401k and you pass away and that child's still young, the day they turn 18, if they live in Utah, that money releases and it's all theirs. And that can be a lot of money flowing to your 18-year-old, and they may not make the best decisions with it. So a trust can be in place to say, hey, this money is going to go towards college. Or what's often the case is we'll set up a trust. They'll say, we'll release 1/3 of the money at the age of 20, 1/3 of the money at the age of 30, and then the remainder at the age of 35. So that you give that child of yours or whoever you're leaving behind some time to mature and grow and then become a little more responsible with that money. So something to think about. And then a rollover, last thing on this slide is when we take that money from a 401k and you move it directly to another qualified retirement plan, like an IRA or another employer's 401k if they accept that. And there's no taxes on that rollover because it's going from a qualified retirement account to a qualified retirement account. Hey.
All right, we are at the end of our time.
Yes, we had a fun time today, Robin. You got me excited, and I know it's one. Oh.
Okay, so I mean, did you have other slides? Was this the end?
I did, but we can call it if you'd like.
Okay, yeah, we need to call it. But I just want to say, you are a wonderful expert here. And as you can tell, like I'm an amateur money nerd. Like I love learning about savings investments. I've done this my whole life. So tech moms, I just want to tell you that Rizek is a guy who knows his stuff. Spoken from one who doesn't know her stuff only on an amateur level. But like I loved everything that you said, and it agrees so much with like the way I've always believed. So I'm glad we didn't get some guy in here who's like do all this stuff, and I was like, no, don't really do this stuff. I mean, I love everything you said. What wonderful advice. I've got two quick questions.
Yes.
The first is, do you recommend books, podcasts, other series that people, I mean, your TikTok accounts, your Instagram accounts are fantastic, but you have a couple of things like if someone really wants to learn a little bit more and they're a basic investor, what are a couple of your favorite books or resources that they could search out?
There's some great, oh, wow, what a great question to ask. So there's some great books by the guy who started Vanguard. His name is John Bogle. And he wrote a book all about an index fund in really simple, easy to understand terms. So if you want to look more at investing, that might be a good one. I would just search John Bogle book. He's written a few. There's another one that I like. It's called The Richest Man in Babylon. That's more of like a principle book. It reads a lot like the Bible in some ways, but exciting and energetic. It's written like anciently, and it gives you a story of this person in ancient Babylon and kind of these principles, basic ideas of getting out of debt, saving, living frugally, being wise with your money. I love that book. There's another one written by Dave Ramsey, right? The Total Money Makeover. If you are focused on getting out of debt and getting your life in order, getting on a budget, that could be a really good choice for you. And the Dave Ramsey podcast is excellent as well for getting out of debt. So we differ a little bit on the investing side and the tax strategy side, but for the most part, we see eye to eye. Yep.
Okay. And then one final question. We got one more minute.
Yes.
If you were a woman who hadn't, invested kind of in a typical situation of her life and got her first job, paying a good salary and like having some options with a little disposable cash for the first time.
Yes.
You would recommend very first, make sure you've got your 3 to 6 months emergency fund, right?
I would.
Okay. And what would your next 3 steps be?
I would do a 401k if the employer offers you a match. So I would contribute to that. And I would make sure that if there's an HSA, if you have a high deductible plan, sometimes they'll toss in a little bit of money as an HSA match. Then the next question is, hey, are you saving for retirement or shorter term goals? If it's for retirement, then a retirement plan like a 401k or an IRA might make more sense. If it's for shorter term goals, like buying a home, maybe in the near future, a brokerage account might be better suited for you. because you have more flexibility on the timing.
And
Yep.
can you give us a target? Like, if we could get to it, what would you recommend a target savings rate for us with that first job?
If you're just now starting out and let's say you're 40, it's got to be at least 15%.
Okay.
It's got to be, because we got some catch up to do. If you're
Yeah.
older than that, it needs to be a little bit more.
If we're
And I'll tell you,
younger,
once you set it up, it can be automatic and you'll forget about it. And that's the best way. What were you saying, Robin?
I was going to say, if you're younger, like I sometimes hear like pay yourself 10%, right? But
Yeah.
you're saying if we're already 40, we got to bump it up to 50.
You got to catch up. You got some work to do. That's true. That's how it is. And it's exciting when you save. It's not all doom and gloom. Budgeting is like the worst thing in the world. It's exciting when you see your money working for you instead of you working for your money. It's a game changer.
I love it. Oh my gosh, we clearly could have gone on a lot longer. But this was super valuable. So much great information. Rizek, we can look you up.
Yeah.
I'll just make sure that everybody's got your contact info, but also your Instagram and TikTok accounts. That's how people can find you.
Yeah, LinkedIn too. So all three.
Perfect.
Yep.
Wonderful. Thank you so much. It's fantastic. Thanks,
Thank you.
everybody, and we will see you next time.
Thank you.